All right, today we're going to tackle the absolutely massive world of Forex trading. We're talking about the biggest, most liquid financial market on the entire planet. Okay, first things first, let's just try to wrap our heads around the scale here. You see that number, $9.6 trillion. That's not a year, that's not a month, that's how much money is traded every single day on the foreign exchange market. It absolutely dwarfs the stock market. It's not even close. And here's the wild part. Unlike, say, the New York Stock Exchange, there's no building you can point to, no physical address. This gigantic market doesn't have a central location at all. It's completely decentralized, basically a massive global computer network. So that leads to some pretty big questions, right? How in the world does this giant invisible market actually work? And maybe more importantly for you, what are the huge risks that nobody ever seems to talk about? Well, we're going to break it all down. All right, first up, let's get into the basic idea of this market without walls. So the key thing to get is that all this trading, it happens electronically. You'll hear the term over-the-counter, or OTC. All that means is there's no central hub, no single exchange. It's just this huge, interconnected web of banks, big financial institutions, and individual traders all linked up through their computers. And because it's a global network, the market literally never sleeps. Well, almost. It follows the sun around the world. Trading gets going in Sydney and Tokyo. Then the action moves over to London and Frankfurt, and finally, it wraps up in New York. This creates a continuous 24-hour cycle that runs 5 days a week, from Sunday evening all the way to Friday afternoon. Okay, so how does a trade actually happen? Well, we need to talk about the absolute core concept of Forex, trading pairs. See, in Forex, you never just buy, dollars. You're always trading one currency against another. They're bundled together in what's called a currency pair. And the most famous, most traded pair in the world is the euro versus the US dollar, which you'll always see written as EUR/USD. So let's just break that down really quick. In that pair, euro/US dollar, the first currency, the euro, is called the base currency. The second one, the US dollar, is the quote currency. The price you see just tells you how many of the quote currency it takes to buy one of the base. So if the price is, say, 1.08, that just means it costs $1.08 to buy one single euro. Simple as that. Okay, so this leaves you with two basic bets you can make. If you believe the euro is going to get stronger compared to the dollar, you go long, you buy the pair. But if you think the euro is about to weaken, you go short, you sell the pair. It's really that simple. You're just betting on whether that first currency is going to go up or down. All right, now we need to talk about the one thing that makes Forex so alluring to so many people, and also what makes it so incredibly dangerous. I'm talking about leverage. So what is leverage? Think of it like a short-term loan from your broker. They'll give you these ratios, like 50-1, or sometimes even way higher. And a 50-1 ratio means that for every single dollar of your own money you put up, you get to control $50 in the market. It's a way to massively amplify your trading power. But, and this is a huge but, here's the catch. Let's walk through a quick example. Let's say you start with $1,000 of your own cash. You use that 50-1 leverage, and suddenly you're controlling a $50,000 position. Now, what happens if the market moves against you by just 2%? A tiny little move, right? Well, 2% of $50,000 is $1,000. Poof, your entire initial investment is completely wiped out, gone, just like that. You see, this is why they call leverage a double-edged sword. Sure, it can pump up your profits, but it pumps up your losses just as much, if not more. A tiny price move in the wrong direction can erase your account way faster than most beginners could ever imagine. And while leverage is probably the single biggest risk, believe me, it is not the only one. So let's zoom out a bit and look at the tough reality of this market and some of the other challenges you'd be up against. The challenges here are, well, they're immense. You've got extreme lightning-fast price swings. You have to understand a super complex web of global economics, politics, interest rates. Then there's the intense psychological pressure of fear and greed messing with your head. And on top of all that, you, as a small retail trader, are literally competing against giant banks and hedge funds that have way better tech, way better information, and way lower costs. Let's be clear, this is not a level playing field. And then Then you have the outright scams and market manipulation. And we're not just talking about some shady guy in a basement. We're talking about huge systemic issues. The Forex probe uncovered that some of the biggest banks in the world were literally colluding to rig exchange rates. And then you have a case like FXCM, a huge broker that got banned from the US because it was secretly betting against its own clients. Think about that. So, after hearing all of that, we have to ask the big question. Is Forex trading actually for you? Let's look at the final balance sheet here. In the pros column, you've got the world's biggest market, it's open almost all the time, and you can get started with a relatively small amount of capital. But in the cons column, wow, you have the catastrophic risk of leverage, it's incredibly complex, it's less regulated than stocks, and you're up against the biggest players in finance. It's a real trade-off between massive opportunity and equally massive risk. So, what's the bottom line here? Look, success in Forex is not a get-rich-quick scheme. Not even close. It demands a deep understanding of the markets, ironclad discipline with your risk management, and, this is the most important part, you should only ever trade with money you are fully prepared to lose. Every single cent of it. And that really leaves us with one final tough question to think about. In a game where the big banks seem to have every possible advantage, what does it really take for a regular person to actually come out on top?